Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities.
Welcome back to Requity Insights. I'm your host, Luis Velez, and I'm joined by my co-host and the CEO of the Requity Group, Dylan Marma. In today's episode, we'll be discussing what it means to have an opportunistic real estate strategy. There are four main investment profiles in the real estate investing spectrum: core, core plus, value add, and opportunistic, with each one of those gradually taking on a little bit higher risk profile in expectations of generating higher returns. While traditional approaches can be effective, opportunistic real estate investing offers an ability to maximize returns by seeking out undervalued or underperforming properties in often overlooked asset classes and unlocking their full potential. With the right approach, investors can utilize this strategy to create significant value while still properly mitigating risk. Dylan, do you think you could tell us what an opportunistic real estate strategy is?
I think the big thing to keep in mind is that this is a spectrum, right? These are not buckets of core, core plus, value add, and opportunistic, and every deal perfectly fits into one of these buckets. This is just a spectrum, and my view on risk is going to look very different than your view on risk and different than any other investor's view on risk. We all have a different weight that we place on various risks. So I think that what is opportunistic to one may not be as much to another. Yeah. So I just want to always preface with that. I think when we talk about this is not a binary thing where you just have fixed buckets, but rather this is a spectrum and will vary, and what you view as risky now will change over time as well. But speaking more specifically towards opportunistic real estate strategy, what this is usually going to entail what the world perceives as a more risky investment strategy to generate an outsized return. And what that looks like in today's world is probably somewhere, if we're talking about acquisitions, I almost put acquisitions as their own spectrum, and then you have development as a separate spectrum that is trying to target even higher returns. But speaking strictly about acquisitions, this is usually an investment that entails taking on more perceived risk to be able to generate a higher overall return. When you look at maybe a core strategy, don't quote me on these numbers, it's going to vary by asset class, but you might be looking at 9 to 11% net to investor return profile. When you're looking at a core plus strategy, you may be looking at 11 to 14% net to investor return. Value add strategy is probably more like a 14 to 16% net to investor target return. And then the opportunistic strategy sits on top of that, probably somewhere in that 16 to 20% net to investor return profile. And in terms of the risk that you're taking on to be able to get that incremental greater return, that can fall into a number of different forms. That could fall into the risk in getting into a heavy distressed asset that maybe is a heavier lift that, say, take a typical multifamily building, maybe it requires significant renovation, $25,000 a unit, and you're starting to take on not just typical acquisition risk, but you're taking on now more construction risk and more lease-up risk. So it starts to get closer. It's not a development deal. You're not having to take on entitlement risk and some of the horizontal risk that you do on a full-on development, but you still have development level risk that starts to give you a blended return that targets a higher net to investor return on more of a distressed asset, right? And you have lease-up risk and things along those lines. So whereas on another way that you can get an opportunistic return is by getting into some of these less ventured asset classes, right? When we first started looking at mobile home parks, we were still able to get opportunistic returns with pretty fair, could call it conservative underwriting, to be able to generate, because that's what the market viewed it as. It was this kind of obscure thing that was not highly sought after and was a little bit easier to get an opportunistic return, whereas now that starts to fall into more of a traditional real estate asset type in most people's eyes. So mobile home parks can be core assets or they can be value add assets, and only in the cases where you have heavy infill or heavy lift mobile home parks are you able to find those opportunistic level returns, right? Whereas the RV space right now, what is a typical, call it value add deal in the RV space, being it's a space that's got less competition and is less sought after right now by the capital markets. A value add deal typically targets more opportunistic returns, right? So you can see how it changes by the sector, where when you have multifamily, you need to take on really, really heavy lift to get an opportunistic return. Mobile home parks are now becoming similar to that. RV campgrounds, traditional value-add deals are going to be, most people are probably going to pencil them to try to get more opportunistic returns. You could probably say the same thing about, parking lots, or we talked recently about glamping, outdoor hospitality, right? These are more obscure asset types that generally are going to target a higher return, even on a traditional value-add play. So hopefully that gives a decent idea as to opportunistic investments.
Yeah, I think that's really clear on the opportunistic side. Kind of diving into some of the other ones in that group, the core plus, and value add. How do those differ? Those strategies differ in comparison to the opportunistic one.
Mm-hmm. So you're looking at all aspects of the deal, right? And you're trying to put weights on each component of the deal. Typically, core and core plus, the only difference between the two is generally just the location, right? It's usually you're buying a stabilized asset that is a high quality asset that you see value in holding long term, but this is a MSA that might only have 200K population versus a million population, making it kind of fall more into the core plus bucket, right? So, but you're weighing across the board here, right? You're weighing the location. You could probably say that a really tertiary, location that's not even in an MSA that alone can make it an opportunistic investment, right? You could say if I want to touch anything in that market, it's falling apart. Even if it's the best building in town, that's an opportunistic building because it's a really soft market, right? Yeah. So you got to weigh the location first and foremost into the equation and think about what level of underlying risk do you foresee, or what level of underlying opportunity do you foresee within that location. Then you have to weigh the asset class itself, right? How is this asset class being perceived? Of course, right now, all of the news is flooded with talks on office space, and anyone touching office space is instantly considered opportunistic, even if you're in the best location in town and the best city in the country. Right now, you're viewed as opportunistic for jumping in and touching office space, right? Whereas multifamily has been, or industrial even, right, has been the most sought after asset types, in the last decade. So those asset types inherently are looked at as lower risk because of the amount of liquidity chasing those asset types, right? Then you look at the vintage, right? Are you taking on, is it a newer asset? Usually more core plus are associated with newer assets, whereas value add generally entails, right, every 10 years or so, buildings are starting to build up deferred maintenance, and there's some kind of a value add play to it, right? And so look at the vintage that takes place, the physical infrastructure, the amount of deferred maintenance that needs to take shape, and then I think lastly is the business plan itself, right? Is there construction risk? Is there partial development risk? Is there expansion risk? Is there lease up risk? Is there operations risk, right? If you're running a hotel, you might have a lot more operations risk. That's really depending on the property manager to be really on top of it. Or even an apartment building can have significant operations risk, right? That you're putting a lot of weight on the third party in place. So I think you have to look at the operations or the business plan risk too, and try to deem, do I consider this to be a low risk business plan, with a high probability of execution, or do I see a lot of variables in this business plan, which therefore makes this riskier? Yeah. And I think as you're analyzing, all those different categories, you're starting to kind of be able to best pinpoint, where this deal falls on your perceived spectrum of, where the returns should be.
Yeah. What would you say are some of the pros and cons of utilizing an opportunistic real estate strategy?
So if we talk about opportunistic real estate as just a strategy as a whole, and say that, in a lot of cases, big institutions, they have opportunistic funds, right?
Gotcha.
Or sometimes, for us, I'd say like we typically teeter the line between value add and opportunistic, and we've usually targeted what some would consider to be opportunistic returns on a lot of our deals, just because that's where we saw the best, what we consider risk-adjusted returns was through targeting a little bit higher returns, but taking on what we consider to be more value add level risk with opportunistic level returns with these asset classes that are maybe not as mainstream when you look at, us getting started with MH and then doing a lot of RV recently. But in terms of making that a strategy and focusing exclusively on targeting opportunistic level returns, that starts to become, there becomes some very clear downsides to doing that, and there's also some good upsides to doing that. But I'll start with the downsides as a strategy. You would lose the ability, you oftentimes can lose the ability to specialize if you exclusively focus on targeting opportunistic level returns, because if it was easy and these were cookie cutter deals to be able to generate that kind of returns, the rest of the market would catch on and the returns would probably get compressed over time. Yeah. So there's generally either extreme skill involved and extreme specialization, or it's something that you can lose over time because you are, again, maybe you're pursuing an asset class or a strategy that is just not as competitive right now. And if it's a good one, chances are it will become more competitive. Yeah. So you will find that the pioneers, in these sort of situations, like they generally times change, things change, and at some point in time the market will kind of normalize. So that may put you in a position where you find yourself targeting, kind of a moving target of where that opportunistic return profile is, versus if you are targeting just one asset class, you're just going to know that asset class, and you're going to have to ride the wave of where the returns are in that asset class. If it becomes more popular, you're going to have to start accepting lower returns, right? Or you maybe have a different perceived level of risk in the asset class. So I guess that's the downside to targeting opportunistic return profiles. And then the other downside is just that you could be taking on more risk, and you oftentimes are taking on more risk, and you need to be able to be educated on those risks and do what you can to mitigate against those. So I think that's a lot of that. And then on the upside of it is that you generally are going to, I think over the course of time, I think you'll get higher returns if you're primarily playing in the opportunistic space and swinging for higher returns and doing what you can to protect your downside. I think over the course of time, again, it all depends on the level of risk you're taking on, but I think you can get higher returns. I think there's always capital looking to maximize its returns, so a lot of capital will be attracted to opportunistic return profiles, depending on where you are in the market cycle, right? Of course, during down times, people may be more conservative, but during good times, people a lot of times have a tendency to want to maximize their return on investment. So yeah, there definitely are pros and cons, and it's a delicate balance on trying to get. It's all about risk-adjusted returns. It's not about best possible returns. It's about finding what you believe to be the best return while taking on the lowest amount of risk to be able to achieve that return, right? And having high conviction and being able to hit that kind of return.
Yeah, absolutely. Touching on what you just said, how do you mitigate risk in an opportunistic real estate strategy, and how do you get yourself comfortable with the strategy and see opportunity where others may see risk?
That is a great question, and that's the million-dollar question I think that everyone needs to figure out how to answer for themselves. You need to educate yourself immensely on whatever those risks are, right? So I can't give a cookie cutter or one size fits all answer, because the risks on operations are going to be very different than the risks on the location, and going to be very different than the risks on the vintage, and going to be very different than the risks on the asset class level, right? So when you're looking at all these factors, you have to isolate each and every one of them and try to question them, and continue to question them until you can formulate your own viewpoint on what you can get comfortable with and what you think is an issue versus a non-issue, and kind of weigh all of the factors into the equation, right? And then at times you'll be right, and then at times you'll be wrong, and you have to learn from the times that you're wrong and iterate, and let your experiences continue to guide you to, over time, make the best possible decisions, right? And that's why this is a lifelong game, because we're constantly trying to identify the risks, and we're trying to assess them and trying to kind of navigate our way through them over time. But I think about the first time for me stepping out of multifamily was a big deal for me, because there was one point in my life I thought I was going to be a multifamily investor for the rest of my life, and that was all I wanted to do. But then seeing changes in the asset class and seeing cap rate compression, I eventually started to look around, and I saw mobile home communities, and I saw this disconnect where multifamily was trading at 5 caps, and in the same market, you could probably get 7 cap or higher, cap rate on a mobile home community. Yeah. And I said, well, obviously, it's a mobile home community. It feels riskier. It feels like it's maybe a lower income on average tenant base, and I'm sure there's got to be a reason that they're trading at higher cap rates. And now, then I started to dig in, and I started to learn that there's actually a pretty similar collections rate between mobile home and apartments. So what I thought was the risk was actually not as big of a deal. And then I also learned that the turnover is dramatically less, because instead of having turnover every 2 years, you have the average person moving out every 15 to 20 years in a lot of these mobile home communities. So you have way stickier, longer term, more resilient resident base. You have collections rate is not as big of an issue as I once thought it was. And then you have your biggest expense in apartments is CapEx, and you take that off the table, and you probably have 10% of the total CapEx expenditures that you do on a traditional multifamily when you're running a tenant-owned or resident-owned community, right? So I think all of these, and then you have the stigma aspect too, right? I think a lot of people are just not comfortable with mobile home communities, right? And I think there's always some value in stigma that maybe will turn other people off. And then I think once I was able to see that, I said, this just doesn't make sense, and this is amazing, and at this price point it makes sense to buy them a lot. Here we are a few years later, and multifamily cap rates are lower than, or a lot of mobile home cap rates are lower than multifamily, right? Wow. So the market woke up to that, and they said, this is really good, right? And now you have institutions chasing it with boatloads of capital, trying to buy them at significantly compressed cap rates, right? But I think, and again, I got lucky, because that could have went the opposite way, and people, there could have been risks that I didn't see, and cap rates could have went up from there, and we would have gotten hurt. But I think that at the time, to me, I had that light bulb moment where it just made too much sense, and I said, we need to buy as much of this as possible at this kind of price point, if this is where the market is, because this is a really good risk-adjusted return, right? And now here we are a few years in, kind of struggling to make sense of where the market is pricing right now, because you fall in and out of alignment as things change, your views change, you have more experiences, whatnot. So I guess that would be my story to share on how to think about the mitigating the risk. It's like looking at it and just doing that, taking that approach of asking the hard questions and trying to form your own opinion.
Yeah. In terms of leverage, does it vary across those strategies? Would opportunistic have a higher leverage than a core?
Yeah, it's another great way that's a great point, and something I didn't bring up was you're not even just taking on risk from your location, all the other things I was talking about, but you're also taking on risks from your structure, right? Are you on the bottom of the capital stack, the middle of the capital stack, or the top of the capital stack? And how much leverage is underneath you, right? Because that can boost a value add deal if you're using a crazy bridge debt, just for example, like you take a value add deal that would be a 15 IRR if it was 70% fixed rate financed, and then put an 85% bridge loan on it that's floating rate, and now your IRR might be high teens before you know it, and you have much more potential upside, but you're taking on a lot more risk. So the deal structure in itself can also be a huge component of the risk, right? Whereas you may view pref equity investments that sit first in line after the debt, but offer a lower return, you may view that as, usually it should be a lower risk investment, right? So I think that thinking about the capital structure definitely plays into this big time.
Yeah. Not being a single asset class focused operator, when you look across the space, how do you identify opportunities?
Yeah. Well, we are close to single asset class focus because we know how to run communities right now, right? That's like our big thing, is we try to stay in the world that we're comfortable in, and that is generally kind of apartments, mobile home, RV, right? We're doing something very similar. We're running mostly multifamily type communities where we offer mostly long-term stays, but also some short-term stays in the mix of there. So I think when you look at our wheelhouse, like we still have a really high core competency, and there's a lot of crossover between everything we do that allows us to execute well. But there's of course nuances that come along with it too that we've been able to learn over time. Yep. But I guess what I would say, because we do like to keep our eyes out there, at other asset classes and just understand what the market's doing as a whole, even if it's just purely just for thought experiment. What I would say is that, for someone that is looking at, and even for myself, if I'm looking at something that is not in my wheelhouse currently, it has to be an extremely good opportunity, right? It has to be something where you have such high level of conviction that even if you screw up, you're still going to make a good return, right? Yeah. Like, I think that's the key, is that you need what, the Ben Graham, like Buffett and Munger always refer to as like the margin of safety, right? And I think that as an investor, that's how I feel, at least, is that if I'm going to step anywhere out of my circle of competency or my circle of being comfortable, I need to see that there is such a good return, or I'm getting such a good price that I feel really good that I can pull this off. And again, the risk-adjusted return is there, right? I'm not going to jump into something and say, like, if everything goes perfect, I get a really great return. It's like, if I screw everything up, I still want a good return, right? And that's the time when it makes sense to me, is that if I screw everything up, I'm still really happy with the end result. That's when I think it makes sense to move into another asset class, and that's probably when you might have that moment, a light bulb moment, where your signal is going off saying, this seems like a good opportunity, this seems worth my attention, kind of thing.
Yeah, that makes sense. How can an investor determine if an opportunistic real estate strategy is right for them?
I think you'll know just off of your general appetite, right? For some people, multiplying their money as fast as possible is just not their goal, and their goal is to get maybe more in-place cash flow and take less risk on and have lower leverage, and all of these things all come into the equation. But if we're just talking about, should you look for higher return investments or should you look for lower return investments, I think you just have to really kind of feel that out for yourself. And I think it's smart to not be all or nothing, right? I think you should invest in different aspects of the risk spectrum and target some stable, secure investments that preserve your capital over time, while also targeting some maybe opportunistic return profiles that give you some potential for some alpha, right? And then also remembering that if you're targeting opportunistic deals, it's not about going all in on one deal. It's about spreading it across a portfolio of different deals and spreading it out so that you can take on less risk while still having the potential for those sort of returns, right? So that would be my 2 cents, is just probably spread it out and Just, you'll know, you probably know by now yourself well enough to know if you like to swing for the fences or if you're more focused on just long-term preservation.
Yeah, thank you for sharing your thoughts with us, Dylan. Well, there you guys have it. That's a brief introduction to the 4 different strategies: core, core plus, value add, and opportunistic. That's all for today's episode. Thank you for watching. If you enjoyed the content, please remember to like, share, and subscribe, and we'll see you next time.
Thanks for tuning in to another episode of Requity Insights, hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.